Hello, my name is Joe Hoyle, speaking to you from Richmond, Virginia, where I'm on the accounting faculty of the University of Richmond. This is our second video lesson about cost flow assumptions. And you have a very interesting case here about the choice of making a cost flow assumption. Your uncle owns an office supply company. And when you first start a company with inventory, you typically have to make a cost flow assumption. Often you make that decision, you make that assumption before you even understand what it means. In this case, your uncle's accountant recommended LIFO. Your uncle's accountant recommended last in, first out. Apparently the uncle wasn't even 100% sure why that decision was made. A lot of times in business you kind of turn these kinds of decisions over to the experts, but you really need to know what that means and how that decision will impact your company. And in this question, a friend of your uncle's or a person that works with the company talks about IFRS and makes a comment that LIFO, last in, first out, under international accounting standards is not even permitted, it's not even allowed. And that kind of worries your uncle. I'm using a system that can be used in the United States, but it's not even allowed in other places. Now, ever since I was in college, what we use in the United States is U.S. GAAP. It's produced by the Financial Accounting Standards Board, and anywhere in the United States, GAAP is the king for financial accounting. But over the last 10 years or so, there's been a fairly significant movement that the same accounting systems, the same accounting rules, should be used throughout the world. Most companies today don't just deal inside the United States. They'll have operations in England or operations in Italy or operations in Tokyo, places like that. And now, today, the accounting rules in the U.S. are GAAP. But the rules in almost every other country are International Financial Reporting Standards, called IFRS. And there's a big discussion as to whether the United States, in order for there to be one language for the entire world, should switch over to IFRS. Some people believe that GAAP is much better. Some people believe that having one accounting set of rules for the entire world would be much better. It's a really big debate today. But in our case here, the discussion is about one element of that debate. In U.S. GAAP, you can use LIFO. In IFRS, you cannot use LIFO. Now, you might ask, why does IFRS, why do International Accounting Standards not want you to be able to use LIFO? There are problems with LIFO that are very difficult to work. One of those is that the number on your balance sheet for inventory tends to be a very low number under LIFO after enough years. If you have inflation, that number becomes outdated and becomes, according to many people, a completely useless piece of information. So internationally, this is not a system that people like. However, in the U.S., Congress has said that if you want to use LIFO for your tax returns, you must also use it for your financial statements. Now, that was not FASB. That was not the SEC. That was U.S. Congress. If you use LIFO for the tax returns, you've also got to use it for your financial statements. Now, my guess here is that your uncle's accountant recommended LIFO because he or she wanted to use LIFO for tax purposes. When you have inflation, LIFO gives a lower reported net income. And if you have a lower reported net income for tax purposes, you save tax money. So my guess is the original decision was purely done to save tax money. However, in the U.S., if you use it for tax purposes, LIFO must also be used for financial statement purposes. So your uncle's company is using LIFO on their balance sheet and using LIFO on their income statement. The ending inventory, the cost of goods sold, are both determined based upon LIFO. If we ever have a system where IFRS, International Accounting Standards, are used throughout the U.S., your uncle may have to change. But is there any problem with using LIFO? The answer is, as long as you realize that it does create some odd problems, and you realize that, then there's nothing wrong with using LIFO. You must understand that you're probably using it so that you can reduce your taxes. And basically, you're accepting those problems as the price you're paying for a lower tax bill. But that's the practical reality of U.S. GAAP. If you want to get the benefits for tax purposes, you've got to accept the problems that LIFO presents for financial reporting. And what's the main problem? The main problem is that over enough years, if you have inflation, the inventory balance in your assets will be a very old cost. For example, if you started in business in 2001 and it's now 2013, it might still be the cost from 2001 that's reported as the inventory balance in your assets on your balance sheet. And to have a 2001 cost in the current year might seem kind of strange, but that's LIFO. This is inventory costing and some of the interesting ramifications of choosing between FIFO and LIFO, especially since there's some movement for International Accounting Standards to become the standards even in the U.S., and they don't allow LIFO. This is Joe Hoyle. This is the University of Richmond. Study that material, make an A, do well.